Look, it's the 1st of June. Let's quickly recap the previous 6 months that we've gone through. And for me and for the investors that I help and I speak to, it's very much felt like one step forward, two back, one forward, one to the left, one to the right. It's felt that there's been good moments and then there's been, worse moments. What's been your take on the situation? Why are we in this position where it's, not a straightforward process?
Yeah, first, life is never straightforward or anything. There's always challenges and uncertainties, and we can only see things in hindsight that things were getting effortlessly better or worse or whatever it might be. Let's look at the last 6-7 months. It was very tricky back in September and October. I'm sure everybody remembers that, in terms of worries about, oh my goodness, what's happening with things like bond yields, which suddenly became very popular, inflation, interest rates, and everything else. Since then, we have seen higher interest rates. That has continued. But I'm feeling, and I know it's a little bit controversial, but I'm feeling that we're starting to see lower inflation. All of the world's companies are saying they're seeing lower inflation, but we would expect that because they look at things such as oil and gas prices or shipping costs, and all of those have come down a lot. Us ordinary individuals have been a little bit more impacted by things such as higher food prices. But I'm feeling still there that I know that the government was apparently discussing with the food companies, can we limit prices and things like that? But I'm sort of feeling that prices even there are starting to go down a little bit. But that whole debate has clearly been impactful upon financial markets and our day-to-day sort of levels of certainty or uncertainty. So basically, you put it all together, we've got this big debate still about, do we need higher interest rates or not? Is there still an inflation problem or not? And as a consequence, equity and bond markets go both up and down. Here's the good news. The good news is the last corporate earnings season was workable. And by that, I mean companies were saying generally okay things in terms of not just their profits, which I know is, again, a little bit controversial. If companies are making big profits, are they hurting other people? But profits also mean jobs potentially, or investment into their businesses, things which sort of show general good progress in an economy. You may have seen that the IMF a few weeks ago said that the UK economy was actually not going to go into a recession this year. So we've kind of gone from it's going to go into a recession into perhaps not, and now into it's actually going to have a small amount of growth. So you put all of that together, the backdrop is getting a little bit better. And generally across the world, even though we've got still some great uncertainty, geopolitical uncertainty with matters in Ukraine, fortunately, the broader world is showing progress economically. And I think when I look at sort of general common sense about the importance of talking to other people and trying to do more trade and matters like that, you put all of that together, and I'm not surprised markets have been uncertain. There are still questions to be answered, as I said, particularly about interest rates and inflation. But as always, I'm a little bit of an optimist. The glass is always half full for me. And my feeling is that June and July will actually see some greater clarification on those points. And as a consequence, my hope for the rest of this year in terms of investment backdrop is that the worst thing probably investors could do is say, forget this game, I'm going to keep all my money under the bed and put the covers up or something. I think people should obviously making sure that it's relevant for their profile and age profile and general investment requirements. They should remain invested. They should be looking for opportunities out there. The world is still slowly getting, in my opinion, a better place.
Cheers, Chris. I think the other thing that I get excited about in the world of investments as well is how, yes, we can have these bad periods, but how quickly good moments can come along as well, and how substantial they can be on the returns. And often, if you look at a portfolio's yearly returns, a lot of that, maybe 80%, could come from, maybe 2 months of the year, just because those months move so much. So I think you're right to look at the long-term picture, because good things can happen very quickly. What I want to touch on now quickly is actually what you mentioned there about the data, there has been some good data, hasn't there, in the last couple of days in particular. I noticed India's GDP was better than expected. I noticed inflation in Germany dropped more than was expected. So there are these shoots of progress, but it all seems very much diluted based on the bad stuff that's out there at the moment.
Yeah, absolutely. I mean, you can look at things in two ways. If there were lots of new jobs being created and very high growth, then I guess people and central bankers and government decision makers would be worried about, well, my goodness, is the next step going to be too much inflation, too many other uncertainties? You know, should we be raising interest rates? By contrast, what we've got is a global backdrop which is showing progress, but that progress is not so huge or so massive, and there's still a little bit of inflation out there, that you've got to be a bit more prudent and a bit more aware of that backdrop. So for me, I think what we'll see over the next couple of months, and certainly as this year progresses, is that the world central banks realise that it isn't smart to keep on raising interest rates, because actually some of the inflationary aspects are starting to get under control. Also, it's better to have a bit of growth than no growth. That's kind of a pretty obvious thing. But the trouble is, if you drive interest rates too up, if you've become too obsessed with this hitting this very short-term low inflation level, you just may not get any growth either. There will always be a little bit of uncertainty out there. But if people are overall looking at something in the medium-term basis, progress is still being made. The world is still rolling. We're still growing, even if it's just about, and life will be okay. And as an investor, that's a backdrop which ultimately means that it's smarter to invest than ultimately not. You can, of course, always spend your money on 1,001 things, some of which are very nice and very pleasant. But putting a bit of money, paying all your bills, putting a bit of money into your pension fund or other investment profiles also makes sense for you from a medium to longer term basis. And that's what life is. It's a game of trade-off, isn't it? You've got to do some stuff short term and some stuff medium and longer term. And if you do a bit of both, then my guess is you'll remain a happier and hopefully a little bit wealthier person over time.
Yeah, absolutely. Last question then, Chris. I want to touch on something that has impacted the more cautious investor over the last 12-ish months, which has been the bond market. So we've certainly seen bonds have had a hellish time of late, and the valuations of bond portfolios have dropped significantly, which goes against the fact that they're put into a portfolio normally to be a cautious instrument and to be a safer asset class. So we know the damage has been done. What's the outlook for bonds over the next, let's say, 12 months? And I know it's going to very much hinge on what interest rates do, but what's your gut reaction to it?
So absolutely. Bonds, I guess we've got to do a little bit of a mini historical review. Every decade, really since the 1980s, bonds have been wonderful, because what's happened is inflation has come down steadily, interest rates have steadily come down, and consequently, bond yields have gone down as well. And when bond yields go down, bond prices, bond values go up. Now, obviously, we've had a bit of a change of that in the last couple of years or so. Inflation has gone up a bit, and consequently, interest rates have gone up a bit. And hence, bond yields have also moved around, and that's hurt the average bond investor. What's going to happen going forward? What's really important is, what is the level of interest rates and inflation going to be over the rest of the 2020s? My guess is that it's going to be in the region of 2 to 4% for both of them. Now, I know many central banks are hoping for below 2% inflation, but reality is, as we all know in our day-to-day lives, there's always a bit of inflation out there that we can feel in our day-to-day spending and related. We're sort of, when we look at bond markets today, we're at that sort of level. So my feeling is, bonds will continue paying their yields, which means like an income to investors, but otherwise they won't make you much money. So you'll get some income from them. Currently for UK bonds, that's kicking around at near a 4% level. So that's okay, that's kind of workable. That's probably going to be a bit better than inflation, which I guess is probably a workable backdrop for investors. Is it going to make you a fortune? No, it isn't. But that's what a bond does. As you say, Rob, a bond is there, particularly a government bond or even a corporate bond, is there to be a sustainable part of your portfolio, something which is better than cash in the bank or cash under the bed, certainly, but not as volatile potentially as some of the equity sides, which have potentially greater growth scope over time. So I think bonds are playing the game they're supposed to play, but we should not think that they're going to make everybody a lot of money. But is it going to be steady? I think so. Is it going to be better than doing some of the other alternatives out there? Absolutely. But if you want growth, then you've still got to be probably a bit more equity centered. But that's not saying anything controversial. Frankly, probably any investment analyst would have said that over any point of the last 40 or 50 years. So keep faith, keep diversified, and obviously keep on doing stuff relevant for your personal profile.
Brilliant. Thank you, Chris. Thanks for the recap. I can't believe that the next time we're going to be speaking is going to be in a couple of weeks at our client seminar, and then we'll be chatting because it'll be the 1st of July. So yeah, it seems to come around quicker every month at the moment. So absolutely. Yeah, thank you for your time.
No, all good fun, and looking forward to the meeting in a couple of weeks.